The U.S. President Donald Trump slapping new tariffs on lumber and kitchen cabinets. So what does it mean for the Canadian markets? Let's go to Martin Cobb, Senior Vice President of Equities at Lorne Steinberg Wealth Management. Martin, good to see you. Thanks for joining us today.
Good afternoon, Morella.
So what does this mean for our forestry industry?
Well, these are tariffs that are going to be applied beyond our borders. We've already had tariffs on lumber here. It's this drive for self-sufficiency. And I mean, I read that the US has roughly 1,000 trees per person. So they have lots of trees. The problem is, what do you do with them? You need to saw them up. You need sawmill capacity. You need processing. If you're going to make cabinets, you need cabinetry capacity. So yes, they can slap tariffs on, but ultimately, as I've said before, this ends up as a tax on consumers, a tax on businesses based in the US.
Okay, can the US produce enough to manage without Canadian lumber support?
No, because they simply can't mill the capacity. They do not have, the number of sawmills. I mean, you look at a number of industries. I heard a great statistic the other day in terms of aluminium. If you want to have the smelting capacity for aluminium, which is very energy intensive, you need equivalent of 4 Hoover dams to be built to provide the electricity to do so. This is another example of, quote, national security measures being driven to try and get domestic manufacturing up and running. Are companies going to make decisions based on the whims of an individual who might not be around in 3.5 years' time? I don't believe they will do so. Investing in sawmill capacity is a long-term endeavor. It's quite costly. You can't just slap tariffs on and expect manufacturing capacity to suddenly pick up.
Yeah, it will take time. So despite the trade hits, the TSX up 24% so far this year. How are we explaining that? Are people just looking further down the road, or they're so excited about AI, for example, that they're ignoring the tariff hit?
Yes, I mean, it's been a very strong year for the markets. And I actually went back, Morella, and thought, we were up over 20% last year. We're on track for, if we have a good fourth quarter, another 20% plus year. When was the last time that the TSX index was up 20% 2 years in a row? I was a nipper. I was 7 or 8 years old. It was back in the 1970s. So here we are with a very strong year. Who would have thought, given all the noise, given how weak the economy is, given all the trade uncertainty, that the market would be up so much this year? Now, obviously, gold stocks are a big chunk of that. They've been stellar this year. You take them out, you still have fairly decent returns. The banking sector, all important, certainly contributing. Number of industrial stocks, we own Toromont, Finning, they've done very well this year. So it is broadening out to some extent, even if you take the gold stocks out. But really, as I've said before, the economy and the stock market are not joined in the hip. Tends to be the case that the stock market is a discounting mechanism and is looking through all this noise and all this uncertainty for the years ahead.
Okay, let's get to Imperial Oil, which plans to slash its workforce. They're saying automation, AI, all the technology that's coming into play will help them to save costs. So they want to slash about 20% by 2027. What do you think the impact of this will be like on the Canadian markets and oil producers?
If you're any business, you must always be looking at driving efficiencies. If you're a commodity producer in particular, you need to be driving efficiencies. That tends to get forgotten about when the commodity prices are on a nice upward tack. As we know, oil prices haven't really done very much for 2 or 3 years. So I would expect them to, this is ongoing efficiency movements. It sounds a lot. 20% of the workforce sounds a lot. The savings they're talking about, 150 million, is about 3% of their operating profits today. So it's a big number in terms of the workforce. It's not particularly huge in terms of the bottom line. And the thing about Imperial Oil, which is a little bit unusual, is it can rest very heavily on the corporate function of its mothership, Exxon, which owns a big chunk of the company. So I think it's a sign that they need to be efficient. I think all companies need to be efficient. We own Canadian Natural Resources, which continues to be one of the most efficient operators. But this is slightly different given their relationship with Exxon.
Let's talk about your stock picks. You mentioned one of them, CNQ, which you like, and Canadian CNR also. Tell me about that.
Well, it's really, where I'm coming from is, I used to work at Templeton. And Sir John Templeton, when he was asked by clients, what should I buy? Where's the outlook the brightest? His response would be, you're asking the wrong question. Where is the outlook the worst? Because that's where you will find the bargains. Now, I might not take it quite that far, but I like to look where no one's talking about stocks. So 2, 3 years ago, we were all talking about all stocks because of obviously coming out of the pandemic, China reopening, etc. That was going to drive higher oil prices. Everyone was talking about all stocks. No one's talking about all stocks today. They're all talking about gold stocks. So I like C&Q, 9% free cash flow yield, as long as the oil price remains fairly constructive. They are one of the best operators here in Canada, one of the best operators globally. They will serve us very well. Be able to pay that dividend, pay down the debt from recent deals, have a very strong balance sheet. Just capital discipline is top tier in my view.
So that's CNQ, but why the railway?
Another one, let's go back 5 years ago. Railway, great business. They've been around over 100 years. They'll still be around in 100 years' time. Canadian National Railway, we actually own CPKC as well, but we like this one just because of valuation. You go back 5 years ago, as I was saying, it's trading on 24 times earnings. Here it is today, trading on 2/3 of that, 16 times forward earnings. The business hasn't changed. Yes, there's noise. There's always noise with railways, whether it be harvests, political interference, tariffs, trade, etc. So here we have the stock today, which remains unchanged from what the business was 5 years ago, trading on 2/3 of valuation. Anyone with a longer term time horizon, 3, 4, 5, 10 years, will be served very well, in my view, owning CN Rail today.
Got it. Martin Cobb, great to have you, sir. Thanks for joining us. Martin, Senior Vice President, Equities at Lorne Steinberg Wealth Management.